Mario, I want to start with just an overview of all the banks in terms of what you saw. Thematically, what really stood out for you this quarter?
It was an important quarter for the banks.
Yeah.
If you had focused on our banks early this year, as I did, you would have concluded that the year was going to be a tough year. With all the stuff around tariffs and USMCA early in the year, you would have concluded, as I did, this would have been a challenging year. Economic growth would have been weaker, but in fact, nothing's played out that way. USMCA has shielded most Canadian exports into the US. Canadian government support is there, or at least it's promised to be there. Rates are a little lower. All of that has really helped to support the Canadian banks. So when I look at the quarter, in terms of broad strokes, EPS up 16% year over year. Very good quarter.
And you were predicting 8, right, I think?
Around 8, yeah. So a clear beat. You know, average for our banks over the long term is around 7 or 8%, so a clear beat. Now, lower PCLs were a big part of that, but it wasn't just credit. Overall, pre-tax, pre-provision, or pre-credit growth was 18%, and that was 6% better than we were expecting. Now, importantly, capital markets played a very big role in driving that, and I think some folks would refer to that as lower quality, but nonetheless, it was still there. Revenue was very strong in capital markets. It drove operating leverage of 3.9%, again, well above 1% is around average for our Canadian banks. So in every respect, it was a good, solid quarter for the banks. But below the earnings, what really drove the quarter and made it sound especially good for me is what the banks are saying on credit. The banks are saying that credit losses are stabilizing from here, not getting worse. Now, that could change. If we get a bad result on USMCA or US economic growth falters or Canadian economic growth falters, the banks will have to retract that. But as of right now, the banks are telling us that credit is stabilizing. And it became clear in unsecured lending. Unsecured lending, which is where the risk really is, credit cards, auto lending, unsecured lines of credit, that's stabilized relative to previous quarters. So yeah, all the indicators are pretty good. Now, there's a lot of other economic data that's behind the scenes, but for the quarter, all the themes are positive.
Let me ask you, we'll get into the individual names in a second, but when you think about, you know, some of these other shoes that can drop, right, sure. USMCA or a recession, things changing, how are you going to be thinking about, what are you going to be looking for to understand what's going to have the biggest impact?
Well, unfortunately, so much of it depends on, and it's become binary, is USMCA resolved in a quick, amicable way? That seems unlikely. Because of the characters involved and their penchant for headlines, it seems unlikely to me that this is going to be a nice, easy settlement with USMCA I'm referring to. I suspect that over the next few months, we're going to get a lot of threats, a lot of headlines. And what we're going to have to decide for ourselves is whether we take those seriously or do we just assume this is more negotiating. The market so far has been absolutely correct to ignore most of the saber rattling that we've heard from the U.S. I suspect that's what we're going to get, a lot more of that. I hope the market is right and that we can continue to ignore a lot of the threats, but that's the big one. What happens to U.S. unemployment, U.S. job growth, Canadian job growth? Those are the big ones I'm focusing on.
Which has really ticked down.
It has. It's slowed. It's a little bit uncomfortable because everything was firing along really, really well, and now we're seeing some weak data emerge in the U.S. That will affect loan growth, could affect credit, could affect capital markets. Those are the big ones I'm focused on.
And in light of that, valuations on Canadian banks right now are stretched. So maybe just give us the historical picture versus where we are now.
If you look at the last 25 years, as I do, because that's roundabout when I came into the industry, when I really paid attention, break that up into 1,300 weeks or so in that period. Roughly 66% of the time, the Canadian banks trade, on a forward basis, trade between 10 and 12 times earnings. Right now, on 2026, which is forward earnings, they're around 12.5, so a little bit above average. You can also look at things like price to book, the equity risk premium. All of them will say the same thing. The banks look a little stretched. Now, a stretched valuation in the context of USMCA, US unemployment, the uncertainty, geopolitical uncertainty, you'd say, wow, these things look stretched. Why are we buying them now? There's no shortage of investors that take a different view. One view is, why are you looking at 2026? Growth will accelerate really well into 2027, and on 2027, they trade below 12. There's no shortage of investors that are willing to look completely through 2026, which is a little surprising that we're going to ignore all of next year and the risks associated with next year, but there are investors that do that. There's another group of investors that take even more bullish outlook and say, AI is changing the world. Canadian banks and banks globally will see their expense ratios decline sharply over the next 5 years. Banks are a play on AI, so why are you fussed about near-term valuation? And I hear that all the time. So I apply a very traditionalist view to this. I look at those valuations and I'm uncomfortable when they go through 12, but there's no shortage of investors that do not care.
Speaking of those shortage of investors, or no shortage of investors, the FDI net inflows chart that I had, you think was pretty interesting. Tell me about that.
Foreign direct investment. So it's been a decade since we've seen money flow into Canada regularly, foreign direct investment. And over the last couple of months, I believe this is one that tracks it on a historical basis, we've seen money flowing into Canada. Investors are buying in Canada. Why is that? Has it become sort of discomfort with the U.S.? Is the U.S. just not the sort of reliable place it used to be? Is it U.S. deficits? We've seen what's happened to U.S. long bond yields moving higher. So is it possible that there's a discomfort in the U.S. that's bringing money to Canada? It could be. When I speak to investors globally, and I have been out and about, I've been to London recently, New York recently, and I speak to investors about Canada generally, they're pretty optimistic, oddly. They're optimistic about our Canadian banks and Canadian investing.
Based on?
I think sometimes it's a comparison to the U.S. I think there's a possibility that some folks look at the U.S. as not the stable long-term play it used to be.
Okay, let's talk about inside the sector, some specific names. And you tweaked some of your, it looks like your earnings estimates and your price targets on the banks we went through. Yes, all higher except for one, I think. Let's go through the buys that you have right now. So Bank of Nova Scotia and CIBC. You have a buy on both those banks. Let's start with Scotiabank. What do you like? What are you worried about?
So those two calls really worked well this quarter. Now, I've been a buy on Scotia since November of 2024, and I thought 2025 was going to be the year when Scotia revealed that they were returning to growth in international. It did not happen until this quarter. This quarter, Scotia was clear with the street that this long period of optimization is coming to an end, and optimization is a euphemism for shrinking. We're shrinking, we're getting out of certain relationships and loans we don't like. Scotia's telling us that they're about done there. And if that's true, we're gonna see growth in international lending, Canadian commercial, US corporate. When you layer on top of that Scotia's credit losses should likely come down fairly abruptly next year, Scotia looks like a pretty good grower in 26 and 27. But most importantly, you've got a valuation that is so low relative to the peer group. So I like that combination. A really low valuation when we're clearly seeing an inflection point in growth. That's why Scotia worked so well recently.
Okay, and then what about CIBC?
CIBC is one of those names. It was about 2 years ago, maybe 2.5 years ago. I upgraded the stock, made it our top pick, and I appreciate that there have been plenty of bad calls in my career, but this was not one of them. This is one that really, really works. CIBC is the best performer over the last couple of years. It has gone from a bank that we all looked at as most likely to step on a rake, and they've really delivered. And I'll give it to that management team. Victor Dodig, he's retiring. His last conference call was just last week, and it was a real love, and everybody was congratulating him on a really good career. And he did. He had a solid career. And he took CIBC from an underperformer to at least average, and that's a big deal to me. So CIBC, strong pre-tax, pre-provision profit growth. They're not blowing up on credit. And historically, that's what CIBC would do. They would find a way to hurt themselves on credit. So really, it's down the fairway performance.
And new management, I would expect.
New management, you mean in terms of?
Yeah, coming in as the kind of,
For sure, like Victor Dodig, the folks that he put in charge of domestic retail, the CFO, these are all important moves. And so CIBC, I think in the past had swung for the fences and struck out. The bank now is much more client-focused, middle of the fairway, and that's why the market loves them.
Okay, let's go to the holds. BMO.
BMO's an interesting one. The market really likes BMO. Their U.S. exposure, I think that's what the market favors. BMO strikes me as having some near-term risk, and I'll explain it this way. The market is looking for BMO to deliver very strong earnings growth in 2026, and it's coming on the belief that outsized credit losses in prior years will be mitigated in 2026. A more normal credit picture, maybe BMO with 35 basis points of credit losses, will drive very strong growth in 2026. When you speak to management, however, they're cautioning us that PCLs or credit losses could remain at this elevated level well into 2026. When you ask them specifically why, like why would you say credit could remain elevated going to 26? They'll point you specifically to unsecured consumer lending and the bank's overweight to the mass affluent as opposed to the affluent at, say, a Royal, for example. So BMO is warning the street that credit could remain higher. Analysts and investors are talking about how credit's going to get much lower in 2026. That disconnect creates a risk as we get into Q4 25 for BMO.
National Bank, it looks to me as though it's the only one you actually didn't change the price target when they came out and still have a hold on this one.
See, I felt for some time now that National was trading at roughly the same valuation at Royal, and it is not a Royal Bank. Their business mix is not favorable. Very overweight capital markets, particularly trading, an overweight or a fairly sizable position in Cambodia, where gross impaired losses have materially moved materially higher. So I looked National Bank, and I just don't believe investors should trade at the premium. It was trading at the same bank valuation as Royal. This was a rough quarter for National, where we saw gross impaired losses continue to move higher in Cambodia, and we saw the vulnerability of their trading book. So investors rightfully took National Bank from a premium back down to a more average valuation, which I think is great because it sets them up for a very good Q4. What National Bank can do in Q4 is talk about expense synergies on CWB, funding synergies on CWB, the benefits of converting CWB from standardized to advanced on their capital, which produces a lot of capital for National Bank. So National has a great opportunity to impress the street in Q4 25 with a valuation that looks reasonable. So yeah, I felt no need to raise estimates or target prices on National Bank because in my view, it was overvalued to start with.
And finally, Royal, which you did. You upped, I guess, to 208 from 191, but still a hold.
Yeah, see, Royal was one of those interesting stocks. So in November 2024, I downgraded Royal, which is unusual for Canadian bank analysts to do. Everybody always loves Royal. Downgrading Royal was not an indictment on Royal's performance, but it was just the valuation. It was trading at a very significant premium to the group. If you look at a chart now of Royal's premium relative to the group, it has collapsed. It no longer trades at a meaningful premium. It's still a premium, but not a meaningful premium. So it is quite easy for me to become a little bit more optimistic on Royal. I'm looking for a better entry point. And ultimately, if I'm not bullish on the group, I don't want to have too many buys on the group. So Royal just doesn't fit in. But after after Scotia and CIBC, Royal would be my next pick.
Well, one last question for you. For someone who's watching, and again, a lot of Canadian investors own a lot of these stocks, what have we not talked about that you think people need to pay attention to as they go forward?
I think as we think about 2026, what I'd ask investors to think about the most is, how do you feel about the world going into 2026? How do you feel about the Canadian economy or the U.S. economy? How do you feel about USMCA? Do you think it'll be effortless? It'll be smooth sailing? How do you feel about unemployment? And if your view is that going into 2026, things feel a little uncertain about trade, a little uncertain about unemployment, and a little uncertain about the macro picture, then reflect on this. Canadian banks are nothing if they're not just a reflection of the economy. And if you're uncomfortable about how things are shaping up for 2026, then you might want to be a little uncomfortable about Canadian banks as well. And in that context, they're trading at a premium valuation. That to me is the whole ballgame. If you're a little uncomfortable with the macro picture, you might want to be a little bit uncomfortable with the Canadian banks heading into 26.